Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Good afternoon, everyone. Welcome in. Welcome to Coasting in Retirement. Thank you for joining us today. We have another great show coming your way. We have another great guest host, and I believe we probably have one of the most important investment topics we've ever covered on this show. Now, regular co-host Michelle is off this week. In her chair, let me introduce Mr. JD Gardner. He's the CIO and founder of Aptus Capital Advisors. JD, how you doing?
I'm doing good. Good to be here, Josh. Thank you.
Thanks for joining us. Hey, JD, would you mind to just briefly describe Aptus and your role, and then we'll circle back to all of this.
Sure. Started Aptus in 2013, and really what we are two things. We're a true asset manager, and then we are a service provider to the independent financial advisory space. So in a nutshell, that's what we are. Happy to dig in any of those if you want to, but
we're digging into all of it, buddy.
Perfect.
Yes. All right. So listeners, JD and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store for you today. First segment, deep dive on our topic of the day. You will want to listen. Second segment, it's about 25 minutes past the hour. We've got news of the week where we read recent headlines, financial headlines. And then roughly at 45 minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. And it's usually, JD, it's usually where Michelle gets to make fun of me, but she's not here. So we're going to see if any of your predictions or any of my own hit the bullseye or maybe something we'd like a redo on. So listeners, buckle up. We got a lot to get to. A quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. We are an independent investment management and financial planning firm. We have offices in Fairhope, Orange Beach, and Mobile. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call at 251-327-2124. Now, if you dismiss that, do not worry. We repeat it several times throughout the show. Also, JD, I'm going to do a quick disclaimer because we're both in the securities business. And also maybe this will help listeners understand the role of Aptus with Gulf Coast Financial Advisors and why you volunteered to join us today. So as I mentioned in the open, JD Gardner is the CIO and founder of Aptus Capital Advisors. JD, you hold the esteemed credentials of CFA, which stands for Chartered Financial Analyst, correct?
That's it.
And CMT, which is not country music television. That stands for Chartered Market Technician, right?
Yes.
Now, we're going to circle back to that because I want people to understand the depth of what that means. JD's firm, Aptus Capital Advisors, serves as a sub-advisor to my firm, GCFA, which basically means that Aptus helps me with clients' investment accounts, including portfolio construction and trading, among many other services, too much to mention right now because we got a show to get to. What it does not mean that JD or Aptus is employed directly by or for GCFA. JD's advisory services are offered through Aptus Capital Advisors. That's a registered investment advisor registered with the Securities and Exchange Commission and is based in Fairhope, Alabama. Lastly, Aptus Capital Advisors and Gulf Coast Financial Advisors are not affiliated. All right, let's get to the show with all that out of the way, Jay.
Perfect.
So, Jay, your firm, Aptus, I'll do credit. You already know this. Has played a critical role in helping my RIA firm, Gulf Coast, get off the ground. And we also have a personal relationship that goes back several years, starting with our backcourt domination of the Fairhope Methodist Men's Basketball League.
You're still out on the court. I'm not anymore.
You've retired, but you dominated. My job was to get you the ball and get out of the way. But a few weeks ago, you agreed to join me on the radio show. And what I did is I asked you, because I thought it'd take you a minute. I said, hey, what are the 2 or 3 topics that you think would be important for our listeners to learn about? And literally with half a second reply back to my surprise, you immediately came up with one. In fact, you said that there's one primary issue that should be on the top of every investor's mind, and that is how to protect your purchasing power. So I want to start with that. Why do you say that, and what does it mean?
Okay. So this is a good setting to discuss this.
Yes, it is.
Yes. And thanks again for having me. So often the financial services world views risk through the wrong lens. So volatility, drawdown, things like that. So drawdown meaning I had $100, now I have 80. Volatility meaning how volatile is the ride from my portfolio's growth. That's usually what people think about risk. What they do not think about is their purchasing power being eroded. So the best way that I can explain it is if you go back to just, we'll use any number. Don't quote me on the specifics here, but
well, on this show, JD, we just get close. And everybody listening understands that.
Let's get close.
Yeah,
so let's say if you gave me $1 million back in, call it 1970,
okay,
and said, hey, here's the safest vault in the history of mankind. I'm going to give you the interest rate, whatever standing interest rates are on that $1 million. Like, it's protected. Nobody can break into this thing. My simple question I always ask is, okay, well, what's your $1 million worth today? And everybody says, well,
$1 million.
It's $1 million.
Right.
In reality, it's less than $100,000.
Okay. Explain.
So, we talk about inflation, and I'll be probably more direct than I should be. Everybody talks about the Fed. What are they going to do with rates? What is CPI? Can we get inflation back down? Remember, CPI is a rate of inflation. The level of pricing has consistently gone up.
Right.
So price increase.
It's a measure of the rate of change.
Yes.
Right.
So another example, and I'll answer your question.
Oh, you're doing it great.
But like in Fairhope, we live in a great part of the world. Mm-hmm. And what bothers me is since 2020, everybody says, well, look, I got lucky. I bought my house. I'm making numbers up, but I paid $350,000 for my house, and now it's worth $500.
Right.
And that's happened. Well, the flip side of that is, well, your dollar is now worth 68 cents or 70 cents or whatever it is. And so your house has just allowed you to keep up. And so what we see and what we say all the time is longevity risk is the problem. It is the thing that should be defended against. And the biggest, when somebody says like, well, I can get 5% from a treasury bill. Mm-hmm. Like I get that. CDs pay you 5% or close to it. T-bills pay you 5% or close to it. And I understand that. And that probably needs to be a component. But the reality is if you stay, that is quote unquote safe based on the traditional measures.
Right.
But Josh, maybe your listeners this will resonate. Like we are operating with 7 to 8% deficits as a country right now.
Correct.
And so like you can tell me to shut up, but I think it's worth mentioning.
Oh, I think this is incredibly important. That's why I wanted to bring you on.
So the 7 to 8% deficits, and why we're so convinced that the issue is purchasing power, which is translated like the risk purchasing power erosion translates to is longevity risk. And when you're operating at 7 to 8% deficits, let's make this really simple. Say we generate $100 as a country. Well,
in GDP.
Right. So just think of GDP as like what we produce, $100.
Okay.
Top line. It cost us, let's just say $7 to get. So we are in the hole, $7 after that $100 is generated. So the question is, how do we cover the 7? Well, the simple answer is our treasury has to issue bonds. And we always ask, well, who's going to be the buyer? Because historically there's been a number of buyers. Right now, that's not the case, but we could have a deeper discussion there. But the buyer is the Fed. I'll tell you who's going to buy the bonds. The Fed's going to buy the bonds, in my opinion.
Okay.
Like, everything has to be disclaimed here. So
understood.
So getting back to my point is when that is the case, every time new debt is created, more money enters the markets. So the supply of money is increasing. And if you're operating at a 7% deficit, forget what the government tells us CPI is. Your target rate of return to protect your purchasing power should be more like 7%. And here's the answer. So if you're building a portfolio, in my opinion, do not flock to the safety of T-bills or CDs as a long-term solution, because you are going to safely erode your purchasing power. And I believe most investors have a responsibility to steward wealth well. And I know that there's there's a tendency to get safe with your money, but the long-term solution is you have to own risk assets like stocks, or else you're going to be the backdrop is going to be, more money printed, more erosion of purchasing power. That's why it's the biggest risk.
All right. So I'm going to jump in because there's a lot of meat on the bone there. So first, for the listeners, let's do this, because you said something that if you had $1 in 2020, by mathematically, just 4 years later, you've technically got, and again, listeners, we're rounding, right? But technically you got around 70 cents. Explain that just briefly. What does that mean?
So the pricing of everything has gone up. And, if you're down here looking for a new boat, you wished you'd have bought in 2019.
Constantly?
Yeah. Or housing,
Right.
Obviously groceries and things like that. And so that's why, number one, the CPI is misleading. I know it's the headline everybody talks about.
Right.
But when you say 2%, that's the rate of change of inflation. But what's not talked about is the difference in price levels. And so price levels, this is the easy way to put it. If you took $500,000 today and were looking to buy a house in Fairhope, in a nice area of Fairhope, like you had a shot to do it in 2020. Now it's really hard to do,
right?
Because the level of prices has increased. And that's where, so it's not that your $500,000 says a different number on a sheet of paper. It's that your $500,000 buys you about 30% less than what it would have back in 2019.
Very good. And so next thing, JD, to go down through this, I'm going to be honest with you. So I have an economics degree. So technically I'm an economist by training, right? A million years ago, Harvard of the Midwest, Missouri State. You brought it to my attention in a recent presentation that monetary supply, something that I studied ad nauseum in college and had completely ignored over the last couple of years. You said, if you're going to pay attention to a number, pay attention to monetary supply. In fact, I don't know if you remember off the top of your head, but from 1960 to 2020, what was the average rate of monetary supply increase, and why does that matter? How does that tie into your stock argument?
Yeah, so I think the number is probably 7.5, 7.4, somewhere in there. So from 1960 to 2024 or 2020, you had a 7.5% growth rate of the money supply.
Every year, 7.5% more money was created out of thin air for the most part.
It's 100% created out of thin air.
Okay, very good. All right, sorry, I didn't interrupt you. Keep going.
Now it's not money in the sense that it's like bills on the street,
right?
But it's digital deposits, and so, we could make this complicated, which we're not going to. But the issue is when somebody says, "Hey, stocks have compounded at," I'm using numbers here, but stocks have compounded at 10%, and CPI is compounded at 2%, and so your real return on equities is 8%. Well, I usually call baloney on that because what really matters is the rate of inflation through the lens of how fast is my money supply increasing.
I understand.
So think about this. And
you're printing new money that is not only new money, but it's actually that those new dollars are devaluing quickly as well. It's kind of a compound effect.
Yeah. So think about this. To me is the most powerful example if I can do it justice.
All right.
So, and I'm using like paraphrasing the Fiat Standard, which is a great book. But when we go, if you sell me your house, Josh, and so let's say your house is worth $500,000. So the way that our system works is I go to the bank and I tell the bank, here's my financials, here's my situation. I'm going to put down $100,000. Will you loan me $400,000? And say the bank says, sure, I'll do it. So 30 days later, you sell me your house. I get a house worth $500,000. You get $500,000. Me as the buyer, I only had to put $100,000 up. So it seems that the bank wins because they get paid on that loan. It seems that I win because I only have to put $100,000 up. It seems that you win because there should be more buyers that could potentially only put $100,000 up rather than the full float. So what that leads to is like it's a win-win-win. Well, is it really a win-win-win? When who's the loser? Well, think about when the transaction started, my $100,000 existed and your house existed.
Right.
At the end of the transaction, my $100,000 was there, your house was still there, but there was this newly printed $400,000. So the purpose of banks is to take money and to multiply it.
Yep, leverage.
How do they multiply it? They multiply it through issuing loans. Our system was built on the need for debt creation. And so as debt is created, new money supply hits the market. And the people are like, okay, well, why does that matter? The simple example I always give is, hey, if I give you a Michael Jordan rookie card where there's been 3 printed in the world, like how much is that thing worth? Who knows? It's a lot.
All right.
Now, if I come out and say, hey, that card I gave you, the company that issued them originally just printed 1,000 more cards. Well, now how much is that worth? Well,
Right.
still worth something, but it's worth a whole lot less. And so the loser in our system is everybody that holds dollars. And the thing that we see, and I know I'm going to ruffle some feathers, but
That's what we're here for. That's what the show's here for, man. It's a straight talk.
Yeah,
we are dramatically different than a lot of the other shows you're going to hear originally.
It really is like nails on a chalkboard when somebody says, well, I can just go to the bank and I can park my money in a CD or in a T-bill or whatever it is. Like, yeah, you can park it there, but over time, if you're not getting the deficit spend rate on your money, you are eroding your purchasing power. You are injecting longevity risk. And let me define longevity risk.
Okay.
It's not like, if you looked it up, longevity risk is not, hey, I've got $100, I'm worried about it going to zero. But for folks in retirement or entering retirement or closing in on retirement, longevity risk really manifests itself through like a change in lifestyle. It's like, hey, I thought I needed $100,000 to live comfortably. Oh crap, I need 120. So to fix that, you either have to, I wish we could, flip a button and magically produce better returns. Hopefully your portfolios are positioned for good returns, but it's the work longer, save more money, spend less. It's a sacrifice on the individual's part or the family's part. And that's how we typically see longevity risk, is people think they're being quote unquote smart and safe with their money when they're owning more things that give them peace and comfort because there's no volatility or very little.
Right.
When in reality, you're just like, your wealth is being confiscated through money supply creation.
Very good. All right. So as we're going to land the plane this way, JD, this is great. So I'm full disclosure. So on this show, we've talked about fixed interest investments, fixed income bonds, MYGAs, Treasury, all that, right?
Yep.
And we've gone through, I mean, as you very well know, it wasn't even a year and a half, 2 years ago when it would have been kind of pointless to talk about a lot of those things because they were paying
nothing.
Had 0.25%.
Yep.
Right. They weren't even on there. So with the rise of those things, I think what I'm hearing to some degree you say is, if that was just in a vacuum, if you didn't have inflation plus monetary supply, then maybe that would be a little bit more attractive option. And like you just said, and I agree with, we both understand why somebody would do that, right?
Yep.
Because especially if you're an investor that's relatively new to the market, say last 10, 15, 20 years, you've never had guaranteed interest rates offers like that. They haven't existed.
No doubt.
But to tie our thing back in together, how does all of that then, you mentioned stocks in the beginning of the conversation. Walk us through why you think that stocks are not maybe the sole way to fight monetary supply and inflation, but particularly one of the best routes, or at least a valid route for investors to look at. Let's do that as we end this segment.
Yeah. All right. Perfect. So the first thing I want to touch on is why stocks are quote unquote risk assets. Why do those make sense? And the second part, I want to give a simple example on like a bond and why I think they make less sense. And now I get there's a behavioral component to like safety and things like that. So, and keep in mind, I'm pretty convicted on like, hey, if the objective is to steward wealth as well as I possibly can.
Understood.
Then
that's the lens you're going to view this on.
Here's my answer.
Right.
So stocks in when money supply is set to expand, and I don't know if anybody listening to this would argue with me on if money supply is set to expand or not. And
it would be a poor argument to make.
We could talk why that is, but
we will in the next segment.
So the point is, equities or stocks, if you own a business, an operating business, like you can grow top line, so you can grow sales, you can improve your margins, you can grow a dividend. There's all types of avenues for equities, for stocks, to like battle against inflationary pressures, which is what you've seen historically. They can produce real returns above the quoted CPI rate, which is bogus, but also the money supply increase. Now, most people listening, or a lot of people listening, either are in this position or have a family member in this position, whereas like, hey, I bought my house, I took out a 30-year note on my house, and it was a good thing, because like I bought my house, I'm making numbers up. I bought my house for $100,000,
mm-hmm.
and I've owned it for 20 plus years, and now it's worth $600,000 or whatever the number is. And I locked my interest rate in and all that kind of stuff. Well, who wins? I won, right? I
Sure.
own this house, this thing's appreciating, and the money that I'm paying back Like the dollars that I was paying back on the note 20 years ago are much different than the dollars I'm paying back today.
Right.
And so who won that transaction? We would both, I think everybody would agree, the borrower
Sure.
won that transaction.
Right.
So my question is always like, why would you want to be on the other side of that? And that's when you own bonds, when you own fixed income, that's literally, you are saying,
You are on the lending side.
yeah, I'm going to get a fixed rate. I can't grow that rate.
Right.
I'm going to get a fixed rate. Sure, you can talk about guarantees and things like that, but I don't think that the guarantees trump the erosion of purchasing power. And that's the point.
Very good. Well, folks, so we're going to continue this discussion on our next segment. Now, if you've heard something that caught your attention, why don't you feel free to reach out to us. We're very easy to get a hold of. You can start by calling 251-327-2124, or you can reach us through our website, gulfcoastfa.com. That's Gulf like the Gulf of Mexico. Coast is in the show title. FA is in financial advisor. On our site, you can send us a direct message. Click on the upper, or you can click on the upper blue button in the upper right-hand corner. That will put a 15-minute introductory phone call on my calendar. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, investments, and money. Every week, we scour what Michelle calls the interwebs for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. So join us after the break to hear JD and I discuss this week's relevant headlines with our News of the Week segment. You have to stay tuned. You're going to love it. See you then.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back to Coasting in Retirement. Your host, Josh Knoll here. So as we discussed before the break, every week we scour the interwebs for financial articles related to our topic of the day, especially articles that pertain to those of you in or near retirement. Our job is to help you all understand how these headlines impact you, especially when it comes to your money. Now, a quick note, if you want to read in full these referenced articles yourself, we include the article links on the show transcript, which you can find on our website, gulfcoastfa.com. Just look under the podcast tab. We upload our episodes every Monday after the show airs on Sunday on FM Talk 106.5. So now, JD, Michelle usually reads the headlines, but also I have to take her place this week. And without further ado, here's the news of the week. All right. So first up, JD, it's a recent article from investmentnews.com. That's a site that you and I'd be very familiar with, maybe not necessarily the regular investor because it's a little bit inside baseball, but it's a good site. It's titled, "Is Growth Stock Domination Coming to an End?" Now, I picked this article because I wanted to get your feedback really in two areas. First, can you describe the role that individual stocks play in Aptus's approach to investing? We touched on it in the opening segment. And two, this article primarily describes the differing opinions that money managers have regarding growth and value stocks. And what I wanted to do is see if you could weigh in on these two broad classes of stocks. And quote, JD, if you don't mind, real quick, listeners, quick explanation. A growth stock is broadly defined as a company that has greater growth expectations related to other stocks in this industry. Think many tech stocks over the past several years, where typically you don't see much of any profit sharing with growth stocks in the form of dividends. On the flip side of that, when someone refers to value stocks, and you can chime in here if you want to, JD, technically they're referring to companies that have a share price below what their fundamentals say it should be. But I would argue that the term value investing, thankfully to Warren Buffett and a bunch of other people, it's also applied very broadly to mature businesses in mature industries that don't see a lot of volatility in the stock price. That's just my opinion, right? So what I want to do, JD, I want to see what you have to say about the role of individual stocks in an investor's portfolio and what you think about value versus growth, or if that's even a real argument to have.
Yep. Yeah, so on the role in portfolios, so like the opening segment, we're obviously big fans of stocks over bonds, and we do a ton of work on not only kind of like stocks in aggregate, but also individual equities. So there is, a level of, hey, this is what kind of we do on a daily basis. So I do have an opinion after thousands of meetings, and a good stock is a good stock, whether it's value, growth, or whatever it is. I think most investors, the biggest kind of behavioral pitfall that we see is performance chasing.
Yep. And
so we could sit here till we're blue in the face talking about why I think growth is better or why I think value is better. Obviously, the headlines this year have been NVDA, like, I'm not saying buy, sell, or anything. I'm just saying it's
shot the moon,
dominated the market.
I read somewhere, JD, that it has gained more in just capital appreciation this year than the GDP of Germany and like the
probably a lot of countries.
I mean, a lot of countries. It's nuts.
So with that said, I think the question is, and investors, maybe this isn't like the most attractive answer, but the point for an investor, like if you want to get something right, get your asset allocation right. If you own stocks, if you own Amazon, Apple, Microsoft, whatever it is, or growth or value or quality or all these things, like the big thing is, do you own stocks, period? Because what we see, and we see it, I mean, my client is a financial advisor. That's who we deal with. And we deal with their clients, at a secondary level. Mm-hmm. But what we see, even in an advisor's seat, hey, if value's outperforming, it's a whole lot easier to buy value stocks. If growth is outperforming, it's a whole lot easier to buy growth stocks. And
or it's easier just to avoid either and just go broad index on everything.
Just own the stocks.
Right.
And that's what we say. Like, we could use technical terms, but we just say give them the equity market exposure.
I like it.
And that's, to me, you don't have to, is growth good? You don't have to guess. You don't have to time. That's a behavioral risk that you just shouldn't take.
I like it. And JD, now I want to make one point clear, or at least my understanding of one point clear. While you do tend to steer towards equities, or at least the fundamental process involves equity investing, right? But you don't totally eschew bonds, right? So let's talk a little bit about that. What role? What's your opinion on bonds in a portfolio? Because I think that's part of this article too.
Yeah, I think there's a behavioral point to where, like, for somebody, like, this is not necessarily like what I would do. Like, there's different people that need different things, and so if you have a real, like, we always talk about risk capacity and risk tolerance. Everybody talks about risk tolerance. Like, can I tolerate a lot of risk? It's like, well, maybe you can, but you don't have the capacity to do it. If risk shows up and it manifests itself in a really bad way and you don't have the capacity, we just put you in a financial bind. And so when you have risk tolerance and risk capacity, I'm more lenient to say, hey, we really don't need to own bonds. Let's own all growth, and let's protect that growth through like what we do, which we can touch on that.
We are going to.
All right. But from somebody that might have the capacity or doesn't have the tolerance, like, bonds are going to be, they're going to be a role, because you're not getting 0%, you're getting something on your money. Now the interest rates, especially with the yield curve doing what it is, meaning like 1 year you get more interest than you do on a 10-year. That's not normal. It's inverted.
That's inverted, right?
So
Talked about it on the show.
So you can take advantage of that to a certain extent, but I think fixed income is more there to be kind of like a behavioral dampener,
Right.
behavioral risk dampener, in my opinion.
Well, and as a lot of people learned in 2022, bonds can lose value rapidly.
Yeah, so like the staple, and this is part of our whole spiel, but the staple in this business has always been own long-term treasuries as your risk management tool. And in 2022, long-term treasuries were down over 20%, over 30% on the long end.
Horrible.
And so obviously that's good for our business because we've been screaming these are not a protector for forever. And people are finally waking up to the fact that, hey, there's some risk in bonds and we can't guarantee that when stocks are down, bonds are up.
Right. Yep. There's more correlation there than what the average investor would maybe realize. Very good. All right. So JD, our next article is from Morningstar. Again, that's something that you and I and people in our industry are going to be very familiar with. Savvy investors probably go to Morningstar. They do a certain ratings of investments, but they also produce a lot of content. And I think more often than not, they generally speaking, Jay, I don't know if you agree or not, but they seem to be fairly balanced, right? Kind of like Investopedia to some degree. Well, they have an article titled ETFs, which is exchange traded funds versus mutual funds, the benefits that really matter. So, JD, I picked this article because I wanted to have the opportunity to expand on our conversation in the opening about the differences between, the different investment vehicles. We've talked about stocks and bonds. Now let's pivot back up a little bit where we talk about ETFs and mutual funds. And as with most things around investing, I know you got strong opinions. So I felt the article did a good job of laying out the differences, tradability, tax efficiency, transparency. I think it also talks about the general differences in fees, which you're happy, welcome you to go into that. So, in my opinion, you're obviously a big proponent of ETFs. In fact, I'd like you to lay out why. Yep. And so would you mind expanding? What do you think about this? The ETF versus mutual fund battle.
So first off, what are they? And they are both similar in the mutual fund business, the ETF business. If you want to own more than one security at one time. So say you take a basket of stocks. Say here's 25 stocks. I want to own them all at once. Well, you can wrap those up. How you wrap those up, like a mutual fund is a certain type of wrapper. An ETF is another type of wrapper. There's a lot of similarities in those wrappers. So this business is so filled with, ETF, 403B, IRA, all these things.
There's so much jargon.
So mutual funds and ETFs are just wrappers. Now, full disclosure, that's how we started the business. Is
right.
we launched ETFs. And now that I've given kind of the politically correct answer, like it's not even close.
Okay.
An ETF is such a better wrapper. The mutual fund business, if it wasn't for the retirement business, so the 401k biz as a whole, mutual fund business, like there's very few people that we see that are opting for mutual funds over ETFs. Now, there are certain things that make more sense to own a mutual fund in, like the underlying components themselves. An ETF is not suitable for everything, but by and large, an ETF is a better way to get broad access to certain asset classes because of the efficiencies.
Well, would you say that obviously the ETF, the mutual fund walked so the ETF could run? Is that fair?
Yes.
Right. You had mutual funds first, and then kind of a natural progression, particularly with technology, was ETFs. And I would say even relatively, years ago when you started your firm, the tipping point I don't think had been reached yet. I don't know when it was mathematically, because again, we get things kind of close here. We're not worrying about getting everything to the penny on our examples, but some point here in the last handful of years, the inflows to ETFs surpassed.
Yeah, so mutual funds, I'd have to look at like total assets, but the flows is not even close.
It's not even close.
Right, and it hasn't been for years.
The investor has woken up.
Yeah, and I always say the like to anything, it's like the market's going to tell you if you're right or you're wrong, and the market is telling us ETFs are the preferred asset. And the whole spiel from the early segment, when we say like, hey, the risk is in owning 5% T-bills, not in owning equities, and people I always say, well, just look at the market. You're plus 15 on the market is telling us that, you need to own risk assets. And I'd rather own them through an ETF than a mutual fund.
And then last thing on that article, because it touched on it in the article, JD, in broad terms, generally speaking, ETFs are considered to be less expensive than mutual funds. Is that fair? And if so, why is that?
In broad terms, but I would say there's an asterisk with that in that the kind of creation of ETFs and the whole how people view them is cheap indexed exposure.
Right.
And so now, we exist because we noticed the ETF wrapper was an opportunity to say, hey, look, is it a good wrapper to own the S&P for cheap? Heck
Sure.
yeah, it's a great wrapper for that. But can you do other things with it? And so you're seeing more and more asset management businesses come to that same realization, partly because what the market's telling them, hey, the flows are in ETFs, not in mutual funds. And so you're seeing these differentiated exposures wrapped up in ETF wrappers. And so there are going to be expense ratios with those things that are different from saying, hey, just give me the broad market
Right.
as cheaply as possible.
Yeah, every time. I can't remember what you may know off the top of your head, but the NBA commercial, there was always, I think it was Fidelity, may have been Schwab, but they were advertising their active ETFs, and it just made me chuckle every time I saw that.
Oh, yeah.
I said, man, look at this marketing at work.
Yep.
All right, very good. Okay, so next up, JD, third article. Now, regular listeners will know that every so often I pull an article from my website, gulfcoastfa.com, for the news of the week. So in that spirit, I'd like to reference an article on your site, the Aptus Capital Advisors website. And in fact, JD, I hope this is okay. I picked the two most recent Aptus articles. I did a two-pack on you. Because I think they both had a lot of value. The first article, the most recent article on your blog site, Aptus Capital Advisors, is titled Leverage Your Way to Better Risk-Adjusted Returns. Okay? That's a mouthful. When we discuss this article, I really want to focus on explaining what leverage is. And this, I want to give you an opportunity to talk about hedging too with that, if that's okay.
Sure.
And then quickly, the second article is just one I'd like you to explain a little bit of the mythology of putting it together. It's called The Market in Pictures, and that goes out weekly, right?
Yep.
And for me, somebody that's immersed in this stuff, and like you said earlier, all the different acronyms and the jargon we have, I find that thing cuts through and clarifies on what actually happened and gives me a grip on where things are at. So let's start with the first one, if you don't mind. Didn't mean to spring two on you, but leverage your way to better risk-adjusted returns. I'd like to talk about that first.
Yeah, I need to say this. Leverage is like the financial dirty word.
Right.
And you have to be really, really careful with how leverage is implemented, or you can get yourself in trouble quicker than you'd like to. But when you think about the backdrop, and we're hinting at a few things with this article that I can't quite talk about yet, but when you think about the backdrop of, what we said earlier, which is, hey, I'm not necessarily worried about CPI, I'm worried about deficit spend because that leads to money creation. So how can I target that deficit spend as my target return? Well, it's really hard to find enough asset classes that can give you that type of return. And so one way to say leverage in a more palatable term would be called capital efficiency.
Okay.
So you give me $1 and I'm going to give you $1.50 of exposure of stuff. And so you give me $1, I can utilize leverage to give you, say, $1 of equity exposure, but I can layer on top another 50% of bonds.
Right.
And so the X's and O's of how that's done, we don't necessarily need to get into.
Well, that'd be an individual conversation, I think is what you're saying. So let me ask you this then on that. So leveraging is an individual conversation. Like you said, it can be a loaded gun,
Yep.
right?
Yep.
But it also can be a useful tool used in the right circumstances. Can you, and I know this wasn't necessarily touched on that article, but it is on the next one, the Market in Pictures. Can you describe hedging and how Aptus use hedging?
Yes. So that was where I was headed, which is the best analogy that I can give is, let's say stocks and bonds. We've talked a lot about them.
Mm-hmm.
Let's say stocks are a more powerful engine towards driving returns.
That's a fair statement.
And let's say bonds are weaker. So the analogy I give, bonds are like your 92 4-cylinder Camry. That's that's the power.
That must be what you drove, if you
bonds.
know that.
Yes.
You make that reference, that means you had one.
My brother did. So the whole point, our business in general and what we kind of always discuss is how can I get more and more of the engine in there, the one that can go really fast. So the long-term game, and this is like a David Dredge analogy, which is he runs some strategies that we that are right in line with how we think about things. But, you don't win the long-term compounding game by being super fast and straight away.
Okay.
You win it by being quick to stop and fast to accelerate. And so if hey, we're in a good market and the road is straight, we want to be able to go.
Let her fly.
I'd rather have the engine, but I better equip that engine with brakes. And so hedging, like going back to the leverage, if you give me $1 and I give you $1.50 of equity exposure with it, meaning I'm absorbing some leverage, so there's more risk, I need to know that I have brakes to accompany that to protect me if I need it. Because here's the thing, stocks and bonds, we talked a lot about that. Bonds have correlation risk, meaning when equities are down, you cannot guarantee that your bonds are up. The world is waking up to that fact.
Right. That was, and listeners, JD saying that because that was kind of an accepted part of our business for decades.
Yes. And so like the hedging answer is, I would rather hold something that does not pay me to hold it. Matter of fact, it costs me to hold it. A hedge costs me money. So somebody would say, well, why would you do anything that's not going to pay you? It's going to cost you. It's a negative carry, not a positive carry. Well, the answer is the presence of the potential payoff will happen. Just the presence allows me to build a bigger engine with my portfolio, take more risk. And the payoff when I need it, well, when you need it? Well, if I own more stocks, I better have the protection if stocks crash, which I know is kind of maybe where we're headed with one of your questions. But that's the point, is a hedge is something that, hey, it's negative carry, it costs me to own it, but its protection is there. There's no correlation risk. A hedge is by mathematically, it goes up when markets go down.
Very good. Now, that's very well said, JD. All right, so last article. Regular listeners will know, JD, that I have a particular irritability around market predictions. It really bothers me when somebody uses fear tactics to sell a product. We always make fun of the hammer in search of a nail sales guy on this show. And as you very well know, a lot of times that leads to an insurance product.
Yep.
So what I'm referring to is, the old market's going to crash. So let's lock your money up over here in this safe money play, right?
Yep.
How many times do we have to hear the forecasters were off their mark with recent prediction, right? So, and as you know, Jay, I even got an entire segment of the show dedicated to showing our listeners that even someone like me that's fairly skeptical can still swing and miss when it's trying to predict the market. So I say all this because I include the next article with a little bit of tongue-in-cheek smirk. It's from Business Insider, and we got just a couple minutes to hit on it, but it has a horrible title, or overwrought title. It's called "Stocks Are in a Sweet Spot, but Bears Still Fear a Bubble is Near Bursting. Here are what 5 forecasters are saying about a potential crash." So here's the thing, JD. I don't want to go through every pro and con of every forecaster's thing there. I mean, to be honest with you, I didn't read the whole article. What I'd like you is maybe reinforce some of the things I've tried to do on the show and try to guide investors on what news they should actually be paying attention to versus what they should ignore, including, in my opinion, the vast majority of forecasters. What do you say?
Yeah. So the simple, like this is a great way to kind of tie up what I've said so far, which is most people could hear us talk and say, man, that's a bad picture. That's a doom and gloom picture. We've got this debt load as a country. We've got this deficit spend as a country. Man, I better lock my money up. Well, it's actually the opposite. You better own stocks, because the path of least resistance is higher for risk assets. Risk assets meaning stocks, meaning real estate, meaning stuff that is harder to increase supply. It's going to increase with the money supply increasing. And so instead of saying, let me time this thing, it goes back to hedging, which is, if the scenario I'm worried about is a stock market crash, well, let's own something that can help me protect in that environment. And by owning that, I can take more of that risk asset on. And so that's literally what I just said is literally the spiel of our entire business.
That is your foundation of your business right there.
And it's, hey, the backdrop, what's it going to lead to? It's going to lead to more money printing.
Right.
I'd almost guarantee that. And so I want to own risk.
Well, one of the things that I picked up on from you in closing several years ago, you said, hey, what we try to do is let our winners run, But we have a plan in place when things don't go according to plan. And I've always stuck with me, a lot of times in my industry, when the market's going up and to the right, when the market goes down, guys and gals in my industry just hang tight, Mr. Investor, hang tight, it'll be fine. But in your scenario, working with my clients and many other clients across multiple financial advisors, but there's actually a plan when things don't go according to plan. So I like it. Well, JD, great job discussing the headlines. I know I've learned a lot, and I think our listeners did too. Now, listeners, if you have questions around the topics in our headlines or just general questions about your investment strategy, your financial plan, or your retirement plan, give us a call, 251-327-2124, or you can reach us on our website, gulfcoastfa.com. Upper right-hand corner, there's a blue button. Click it, put 15 minutes on my calendar. All right, folks, coming up next, Josh's crystal ball and big mouth. What have been some of my predictions? Have I been right? Was I ever wrong? How wrong? What's JD had to say about the past, or what does he have to say about the future? We're going to talk about all these things, and maybe we'll poke a little fun at my big mouth, even without Michelle here. And maybe we'll get to pick on JD a little too. So stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's GULF, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. All right, welcome back. Your host, Josh Knoll here, alongside guest co-host, JD Gardner. So, JD, I'm opinionated. So are you. I have strong opinions at times. So do you. I've always claimed that a radio show host that isn't a little opinionated would not be very interesting to listen to, right?
That's right.
And we're both paid in our respective professions to offer professional guidance and opinions to our clients. Otherwise, what use would we be? So now sometimes I feel so strongly about something that I talk about it publicly. Sometimes I'll even make some predictions. And while I feel I'm usually proved right, because I tend to be pretty skeptical of my own industry, there are times where I swing and miss. So listeners, if you want to hear where JD and I were right, or maybe an example of where we missed the mark, let's get at it with Josh's crystal ball and big mouth. All right, so JD, without Michelle here, I'm going to be the one going here. Now, if you ever listened to the show, this is where she eviscerates me on some certain things. All right, so let's do this one, JD. Here's what we got time for. I'll give you an example. Here's where my big mouth, Josh's big mouth, was way wrong, and my crystal ball was totally broken. And I'm actually embarrassed about it. Michelle never lets me forget about it. But back in July of 2022, I have a podcast, a sister podcast called Every Dollar Counts. And I predicted at that time with Jay, my co-host, and God as my witness, that the current rate of inflation at that time, which, man, I think it was 8 or 9%, I predicted that the current rate of inflation at that time would be going down sooner, very soon. Because typically that's how inflation math works. It's, as you mentioned earlier in the show, the inflation rates are a measure of change. They're not the total change, right? So obviously I was way off, and so far off, I kind of fall into the other camp where I'm not sure when or even if the Fed is going to get back to this, what you and I agree upon, this Goldilocks fairy tale target of 2% core inflation. I think it's nonsense. Now, from a distance, you, on the other hand, you appear to have been consistently more skeptical that stocks were a much better protector of purchasing power and that inflation was not going anywhere and the value of our dollar really mattered. So I'm already telling you I was wrong, my big mouth, and I think you were right. Were you right? And if so, what led to that prediction? How's that played out for you? Yeah,
that's one that I will say that, we've been championing for however long, which was, hey, we think inflation will continue to rear its head and to be volatile, even with, the bogus measures of it. And so, that to us translates to much better real returns for stocks than relative to bonds. And so we've been predicting that, and we've had a couple remember, we've been predicting that since 2013.
You were contrarian until you weren't.
Exactly.
I think that's fair to say.
And so I think it's important to note when you have these when the inflationary issue is kind of out, where it's really showed itself and hurt is obviously not only in consumers' wallets, but when portfolio construction's in play, you can't be relying on correlation benefits that you have been in the past. And so that's kind of what we predicted. And I know you've that's my prediction moving forward is
okay.
I think if we
you're dying on that hill. I like it.
If we sit here 5 years from now,
which we will,
and say, hey, look, have stocks or bonds perform better? I think stocks are going to be. It's not even going to be close.
All right.
Because of listen, Josh.
Yes.
And we can pretty much, you can take this one. We are not, I know we've got something happening in November that tends to be pretty polarizing.
Right.
We are not going to see, no matter which side of the fence you're on, any politician come in and get us fiscally under control.
That ship has sailed.
It's done.
It's over.
And so what does that lead to? It leads to more debt, more money creation. You better own stocks.
That's awesome. You heard it here. We will revisit that in 5 years because that's how I find our stuff. Well, listeners, I hope you enjoyed a peek behind the curtain on how JD and I form our opinions. In that particular example, his was way better prediction than mine. But also that we're willing to admit when we're wrong, which hopefully isn't very often. Now, listeners, if you liked what you heard today, or maybe you just want to have a conversation, we invite you one last time, reach out to us. You can call anytime, 251-327-2124, or you can shoot us a message or make an appointment on our website, gulfcoastfa.com. Upper blue link, upper right-hand corner, or you can do all three. Again, we're pretty responsive to this radio show. We get calls all the time, JD. It's a lot of fun, and it's cool. So, all right, folks, that's a wrap for us this week on Coasting Retirement. I want to give a huge thank you to my guest co-host, JD Gardner of Aptus. Did a great job, man.
Thank you.
We're having you back. Thank you to our awesome radio station, FM Talk 106.5. A thank you to our show producer, that's Mr. Chazare Gray. Many thanks to the provider of our show music, that's local band Sloth Racer. If you haven't caught them, JD, you should. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We would obviously love to be part of your financial journey as well. Till we talk again next week, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and/or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and/or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.